If you glanced at the market headlines today, you probably saw the same weird little contradiction over and over again. Good news, bad stock reaction. Intel posts its fastest revenue growth in almost 15 years, and the shares sink. Oil stays hot, and investors start whispering about a possible upside pop in Occidental. Then Robin Energy goes out and prices a fresh stock offering, and the market basically says, yeah, dilution, no thanks. So what is actually going on here? And more importantly, what does it mean for your money if you're holding tech, energy, or just trying not to get trapped in the next headline-driven swing? Stay with me, because the real story today is not just the numbers. It's the message the market is sending about growth, inflation, and who gets rewarded when the pressure is on. Hey, I'm Vanessa, and I break down the market moves that matter for your portfolio without the Wall Street sleepover vibes. Let's get into it, because today's briefing has a very specific theme. Investors are still paying up for growth, but only if they believe that growth can turn into actual profits, actual pricing power, and actual staying power. And if not, the stock gets punished anyway. That's the tension running through all three of these stories. Let's start with Intel, because this one is the headline grabber. Intel just rode the AI wave to its fastest revenue growth in almost 15 years, with revenue jumping 25%. That is not a tiny beat. That is the kind of number that makes people sit up, refresh the ticker, and ask, okay, is this finally the turnaround? On paper, that's exactly the kind of growth investors have been begging to see from a company that has spent years trying to prove it can keep up in a world ruled by AI chips, cloud demand, and relentless competition. A 25% revenue jump is the best growth Intel has posted since the third quarter of 2011. Let that sink in. We are talking about a company that has been under a microscope for years, and suddenly the top line is moving like it remembered how to run.
But here's the catch, and this is where the market gets picky. Revenue growth is great. Revenue growth is sexy. Revenue growth gets the headlines. But stocks are not paid out on vibes. They're priced on what investors think comes next. And in Intel's case, the market apparently looked at the report and said, nice, but is this sustainable? Is the AI boost real enough? Is it profitable enough? Is it enough to justify a bigger re-rating? That is why shares can fall even when the earnings headline looks strong. Investors are no longer satisfied with "we grew." They want "we grew, margins improved, AI demand is durable, and this is just the beginning." That's a much harder pitch. And this matters for regular investors, because Intel is not just one stock. It's a mood ring for the broader AI trade. When a legacy chip giant shows a big revenue surge tied to AI, people start wondering whether the AI boom is broadening out beyond the obvious winners. If Intel can participate, does that mean the AI infrastructure wave is still early? Or does it mean the bar for AI monetization is getting so high that even a huge revenue jump is not enough to move the stock? That question is huge for anyone holding semiconductor names, because the market is basically deciding whether AI is still in the growth at any cost phase or entering the show me the cash phase. And those are two very different environments. Now, if Intel is the story about growth not being enough, Occidental is the story about oil still having the power to change the conversation fast. According to the market note, if oil holds above $100, Occidental Petroleum could return 20% by year-end. Why does Oxy stand out here? Because it has more direct exposure to rising oil prices than larger energy companies. That means when oil runs, Occidental can feel the effect more quickly and more dramatically. In plain English, this is a stock that can be a lot more sensitive to oil prices than the big diversified names.
That can be exciting if you think oil stays elevated. It can also be brutal if oil rolls over. And let's talk about why this matters beyond the energy sector. Because oil is never just about energy. Oil is about inflation. Oil is about transport costs. Oil is about what you pay at the pump, what companies pay to move goods, and how sticky price pressure can become across the economy. When oil holds above $100, the market starts asking whether inflation is about to get a second wind. That can affect everything from consumer spending to rate expectations to which stocks get crushed and which stocks suddenly look like defensive havens. Occidental becomes interesting in that environment not just because it can rise with oil, but because it can act like a lever on the whole inflation trade. But here's where investors need to be careful. A stock that could return 20% by year end if oil stays high sounds tempting, sure, very tempting. But that if is doing a lot of work. Oil is one of the most headline-sensitive commodities in the world. Supply disruptions, geopolitical tension, demand shifts, strategic releases, OPEC decisions, macro slowdown fears, all of it can move the price. So if you're thinking about Occidental, you cannot just buy the upside fantasy and ignore the downside scenario. You have to ask yourself one very adult, very annoying question. Am I betting on oil staying strong, or am I just chasing a number because it looks good on a chart? Those are not the same thing. Still, compared with Intel, Occidental is the cleaner story in one sense. The thesis is direct. Oil up, Oxy up. Oil down, Oxy gets pressured. That makes it easier to understand, but not necessarily easier to trade. For Americans watching inflation, this is one of those names that can act like a signal. If energy stocks start catching a bid because traders think oil is staying high, that tells you the market is still worried about sticky inflation.
And if inflation stays sticky, that changes the whole conversation around consumer budgets, borrowing costs, and how much room the economy really has to breathe. Now let's pivot to Robin Energy, because this one is a very different kind of market move. And honestly, it's the kind that makes investors groan a little. Robin Energy priced a public offering of 750,000 shares at $4 per share, with net proceeds estimated at about $3 million. And the stock moved down. That reaction should not surprise anyone. When a company sells new shares, existing shareholders can get diluted. In simple terms, your slice of the pie gets a little smaller, unless the company uses that money to create more value than it gave away. Sometimes that trade-off is worth it. Sometimes it absolutely is not. So why do companies do this? Usually because they need capital. Maybe they want to strengthen the balance sheet. Maybe they need cash for operations, expansion, or debt management. Maybe they want flexibility. But the market tends to punish offerings, especially when the company is small and the raise is not especially large in absolute terms. A $3 million net raise does not exactly scream confidence to retail investors who are already nervous about dilution. It can feel like, okay, why now? Why at this price? And why should I own the stock before the capital raise has even had a chance to prove itself? This is where the energy theme gets interesting, because Robin Energy is tied to transportation, which sits near the real-world mechanics of oil and inflation. Energy transport companies can benefit when activity is strong, but they also face capital needs, cyclical pressure, and investor skepticism. When a company like this announces an offering, the market often reads it as a signal that management wants cash more than it wants to protect share price in the short term. That can scare investors off fast. And if you're holding small cap names, this is the kind of thing you have to watch closely.
In smaller companies, a financing announcement can matter way more than it would for a mega cap, because the dilution and the sentiment hit can be immediate. What ties all three of these stories together is not just that they're market moving, it's that they all show investors repricing risk in real time. Intel says growth is back, but the market wants more than growth. Occidental says oil is still a force, but the market knows that commodity upside comes with volatility. Robin Energy says raise capital now, and the market instantly checks the dilution math. Same day, 3 different lessons. 1. Strong numbers do not automatically equal a higher stock. 2. Inflation-linked trades can still move hard if the commodity stays elevated. 3. Financing can overwhelm fundamentals if investors think the deal is a sign of weakness. If you're building your portfolio around these themes, the practical takeaway is pretty simple. In tech, don't just chase the AI label. Look for companies that can turn AI demand into durable earnings power. In energy, don't confuse a bullish oil thesis with a low-risk trade. Higher oil can help some names a lot, but it can also reverse fast. And in small caps, especially companies doing public offerings, always ask how much dilution you're really signing up for and whether the capital raise actually improves the business. Because sometimes the headline is about growth, but the stock is really reacting to trust. And trust is the part the market prices hardest. So if you were wondering why Intel can post 25% revenue growth and still get sold, that's your answer. The market is not just rewarding activity anymore. It's rewarding conviction. It wants proof that the AI boom is translating into a stronger business, not just a better quarter.
If you were wondering why Occidental is suddenly interesting again, that's because oil above $100 changes the inflation story and gives direct exposure energy names a shot at outsized upside.
And if you were wondering why Robin Energy got hit after pricing shares, well, dilution is one of those things investors never seem to love, even when the company needs the cash. That's the market right now. Picky, skeptical, and very willing to punish anything that feels even a little bit uncertain. Which, honestly, is exactly why these stories matter. Because the next time you see a headline that sounds amazing, the stock might still fall. And the next time you see a boring financing announcement, it might tell you more about a company's future than the flashy growth story ever could. I'm Vanessa, and if you want to stay ahead of the moves that actually shape your money, keep watching. Because the market is always telling you something, even when it looks like it's making no sense at all.